Here's a number that'll make your jaw hit the floor. ULTY's distribution yield clocks in at over 80% annualized. That's not a typo. Imagine your bank account paying you 80% interest every year. Sounds like a dream, right? But dreams can flip into nightmares. Because in the ETF world, ultra-high yields are often like free cheese in a mousetrap. Looks tasty until snap. So the big question is ULTY a genius income machine or a dividend trap in disguise? Stick around because we're going to crunch the real numbers, dissect how ULTY works under the hood, and figure out if this is your ticket to weekly paychecks or just a slow drain on your wallet. Quick disclaimer before we dive in. This is not financial advice. It's for education and entertainment only. I'm here to break down ETFs without making you snore, not to tell you what to buy. ULTY is a YieldMax ETF, and it's built using covered calls. In plain English, they take a stock, for example Tesla, and sell call options on it. You collect premiums like rent, but give up the home run upside. Now here's the kicker. ULTY doesn't just pay quarterly or monthly like boring dividend ETFs, it pays weekly. That's like a paycheck hitting your brokerage every Friday. People love that dopamine hit. But remember, if it sounds too good to be true, Wall Street probably designed it that way. So let's peel back the layers and see if this thing's actually paying you real income or just returning chunks of your own money dressed up as dividends. On paper, ULTY looks insane. Over 100% yield. That's enough to make dividend investors drool. But dig deeper into the filings and you'll see the SEC yield is literally zero. Translation? A lot of those distributions are return of capital, ROC. Return of capital isn't evil, it just means you're getting paid out of your own principal. Imagine selling 5% of your own shares each month and calling it income. That's what's happening behind the curtain. So yes, the payouts are real dollars in your account, but are you actually richer? Not necessarily. To really get this, let's walk through a real-world example of an investor who threw big money at ULTY. Let's say you drop $24,000 into ULTY at $10 a share. Pretty clean math. You own 2,400 shares. Fast forward 1 month. The share price slips under $9. On paper, you're down $2,400. Brutal. But wait, you also collected $1,600 in distributions. Now your account's only down $800 instead of $2,400. Fast forward another 6 months. YieldTY switches to weekly payouts, pumping cash faster than your local slot machine. Between reinvestments and income, your account climbs over $26,000. That's actually better than the S&P 500's average yearly return. So is ULTY secretly a gold mine? Or just a magician making your own money disappear and reappear? To answer that, let's talk about the concept of the dividend trap. Here's where the danger lies. Payouts distract you from NAV erosion. Think of ULTY like owning a rental car. You're making steady income renting it out every week. But underneath, the car itself is depreciating fast. One day you look up, and while you pocketed plenty of rent, the car's value is toast. That's ULTY's trap. The dividends look juicy, but the share price may not recover the way you'd expect from a growth ETF. If you only focus on the checks, you could miss the silent wealth drain happening under the hood. But wait, what if you don't just cash out dividends? What if you reinvest every payout? That changes the whole picture. This is where ULTY gets interesting. Reinvesting those monster dividends doubles your share count over time. Back to our $24,000 investor. Instead of holding 2,400 shares after reinvesting for a year, you're sitting on 4,800 plus shares. That's a snowball effect. More shares, more dividends, more reinvestments. This is the classic compounding loop. You stop caring about the headline share price and start focusing on how many little dividend soldiers you've deployed. Each week, they march back with more reinforcements. But what if you don't reinvest, just cash out those dividends for income? Let's run that math. Cashing out, your 2,400 shares never grow, but you're still pocketing weekly paychecks. At the end of a year, you've got $20,000 in your pocket plus about $12,000 left in shares. Not bad, but nowhere near the reinvest snowball. This is the big fork in the road. ULTY can be an income tool for retirees who just want cash flow, or a compounding tool if you reinvest and don't care about NAV erosion. But let's be clear, it's not a growth ETF. You won't wake up one day with Apple-style capital appreciation. By the way, if this is making you rethink dividends, say hello in the comments. I'm curious, which team are you? Reinvest for growth or cash out for weekly income? Now, here's the problem nobody talks about. ULTY's strategy works great in certain markets but can backfire hard in others. ULTY thrives in sideways or mildly up markets. Why? Because you're collecting fat premiums while avoiding huge drawdowns. But if the market rips higher, ULTY can't keep up, you've sold away the upside. If the underlying stocks double, ULTY investors clap politely while missing the moonshot. And if the market crashes? Covered call income won't save you. You'll take the full hit. That's why some investors call ULTY a slow bleed product. You're capped on the good days and exposed on the bad ones. And that brings us to the hidden costs, the ones baked into ULTY's DNA. ULTY charges a 1.3% expense ratio. That's steep in ETF land. Plus, option premiums aren't free money. You're giving up long-term growth to collect them. And with distributions often classified as return of capital, you could literally be eating away at your own steak without realizing it. Think of it like buying a pizza, slicing off 2 pieces for yourself every week, and being surprised when the pizza gets smaller. So, does that mean ULTY is useless? Not quite. There are smart ways to use it if you know what you're doing. ULTY is best used as a tactical tool, not a portfolio core. For example, a retiree could use it for weekly cash flow alongside safer investments. A younger investor could reinvest dividends as a side income play, but no one should treat ULTY like the S&P 500. It's not a wealth builder, it's an income generator. The trap is thinking you've found a magic growth plus income machine. The reality is you've found an income-only machine with clear trade-offs. But what if you want the best of both worlds? Income and long-term growth. Let's look at alternatives. ULTY isn't the only high-yield ETF on the block. QYLD, XYLD, and JEPI all use covered call strategies too, some with better balance between yield and capital preservation. Dividend aristocrats or bond ladders can give you more stability. The lesson? Diversify your yield game. ULT can play a role, but it shouldn't be the only horse in the race. So, is ULTY a dividend trap? If you blindly chase yield, absolutely. But if you treat it like the income-focused tool it is, reinvest intelligently, and balance it with other assets, it can work. The real trap isn't ULTY, it's misunderstanding what it's built for. If this breakdown gave you a fresh take, hit subscribe. And remember, high yield isn't free money, it's a trade-off. The smartest investors don't fall for the trap, they understand the math.